Hello and welcome to the Monday Market Update. I'm Nash Paradise, Director of Sales at UMortgage, and I'm thrilled to have with me today my good buddy for many, many years now. So many years, I don't really want to talk about how long we've been doing this together, but I've got Andrew Cady from sunny Florida. Thrilled to have you with us. Andrew, how are you doing this morning?
Doing amazing. It's a great Monday. Always love kicking it off with a Monday Market Update, so happy to be on.
Awesome. There's nothing more exciting than having a Monday Market Update talking about data during a government shutdown when we have very little data to talk about. So this may be brief. Let's jump right into what happened last week. And I could kind of say more importantly what didn't happen last week. So last week should have been a really interesting week. What do we not have? Well, we don't have the Bureau of Labor Statistics. That is shut down right now as part of the government shutdown. So big jobs report, didn't get it. ADP jobs, neat. Should have been a bigger, impact. It came in negative 32,000 from a projection of 50,000. That is interesting. It's fascinating. We are not growing jobs right now. And what I think is interesting on this too is the revision. The previous months, we were showing 54,000, but that was revised to negative 3,000. So jobs are going the wrong direction. Rates should have responded to that. But what we learned is that while ADP is a lot more accurate than the Bureau of Labor Statistics is, investors don't care. Bond traders don't care. It is a leading indicator of what we're about to see when we get the big jobs report, but it's not enough in and of itself to move the market, which is why we were pretty flat last week. Let's talk about what's going on this week, which is also a lot of nothing. You can see there's a lot of things that have been pulled from this sheet because, hey, government shutdown. We don't have a lot of things going on. We've got, the big news is Friday. We have Michigan Consumer Sentiment Index. That's not really,
which should be CPI data. Like we should be getting consumer price index. We should be getting inflation data, but no, nothing.
Hey, no, Michigan Consumer Sentiment Index. There's nothing sexier than, hey, let's talk about, let's call up your realtors and go, hey, I want to talk about what happened with the Michigan Consumer Sentiment Index. Yeah, no, a lot of nothing going on this week, and there's not much to talk about. So what does this mean for the Fed? What does this mean for the Fed funds rate, and where are things going? I think we can say with pretty definitive certainty that we're going to see our next interest rate drop in October. We've got 94.6% on that. What we normally like to look at are the changes in these numbers week over week, month over month, and see how things are adjusting. But without having this data, everything's been pretty flat. But I find it interesting, Andrew, we are still looking at going back to back on interest rate drops to the end of the year. Any thoughts on that?
I think it's what needs to happen. And I think, as much as we all want the Fed to come out and just cut rates, too much of a cut too quickly can be a problem. We're gonna lead right back into inflation. And so there needs to be a gradual come down of the interest rate. And the thing I thought that Jerome Powell said, ironically, I don't give the guy credit for much, but he said pretty eloquently in his last press conference was a 50 basis point cut would be reserved for if we needed to urgently move the markets. Until we would urgently need to move the markets, it will be 25 basis point cuts. And I actually tend to agree with that. I think if we could have more systemic cuts, consistent, every other or every Fed meeting by small amounts, the market's not going to go into these knee-jerk reaction moves. So I do think we're in for an October and probably a December cut.
Yeah, so slow is smooth and smooth is fast. Smooth is what we're looking for. Smooth is balanced, you could say. And, we have a lot of history to play off of on this, and that what happened last year, in September, we saw a 50 bip cut. And what happened after that kind of threw the markets a little wild. I mean, when the Fed is too late to respond, that's not good. And to give the Fed a little bit of grace in this, jobs numbers have been trashed. Jobs reporting this year is awful. Almost 1 million job revisions. That's not good. When you don't have accurate data, it's hard to know how to forecast things when you have a dual mandate of employment and inflation. And it's a lot easier to make sure the inflation numbers are correct because there's so many different agencies reporting so many different things, so many different ways. And we can feel that. The consumer sentiment means a lot more as it relates to inflation. But jobs, I don't think it feels like bad jobs right now. And I mean, I get your impression there, Florida. I know here in North Texas, shortly after COVID was going on, you started to see a lot of people looking for work, a lot of people, having a hard time, finding jobs after that initial surge of employment came. You saw where it started to turn back a little bit. And then even thinking back, I know, Andrew, you've been doing this a long time, 2016, 17, 18, we saw periods of time where employment was definitely lagging and you could feel it in the market. I don't really feel like we're seeing the sagging employment, but all the data suggests that we are moving the wrong direction. What are your thoughts on that?
I tend to agree. I mean, I also think it's very industry specific. I work a lot with first responders, veterans, that type of thing. And obviously when you get into health, that's an industry that's not going to be impacted at all by economic downturns. People getting sick that isn't dependent on a good or a bad economy. So your health industries, but where I definitely have seen it of recent. For instance, I was working with someone that was a manager, kind of a regional manager in the hospitality industry, out of a job and has been actively seeking employment now for 3 months. Their home buying is on hold, and I do think certain industries are definitely, we're seeing the weakening on it. But going kind of back to what you were talking about on ADP, it's actually shocking to me that the market doesn't react more to the ADP numbers. When we have seen the history of how bad the BLS numbers are, when you take, what was it, a 911 or 918,000 job revision. Now, keep in mind that revision was on top of the already revised numbers. These numbers have already been revised lower and then lower again. And then you just wipe out 52% of all the job gains for the previous 12 months. It shocks me that the ADP has been showing this way ahead of what BLS has been saying. So you would think investors would get smart and say, wait, ADP's been saying this for 6 months. BLS is massively messing up. We should start really putting more onus and more reaction into what the ADP is showing us. But markets just don't tend to react to it.
No, and if the markets don't tend to react, investors aren't going to, react. All they care about is making money. They have a single mandate, whereas the Fed is dual. Bond traders, their job is to make money. So, right. I mean, we can't pretend that anyone's going to be looking at this data and the information from ADP and say, oh, well, I'm gonna move funds over here. I'm gonna move things this way because I know what the real story is. No, if the money isn't following after that, you're going to lose money in the interim until that revision, and you're not going to be a very good bond trader. So let's talk about, we know where Fed funds rate's going. We know we've got 3 drops this year. After that, it doesn't really matter. Let's talk about how does this impact mortgage rates? And the graph's kind of interesting right now because we have 3 different tracking metrics here. You've got your Mortgage News Daily, Freddie Mac, and the MBA. And obviously Mortgage News Daily is the most accurate, the most frequently updated. That's our blue line here. They all move pretty much together, but I feel like our blue line is the most consistent. After that lull and that drop, we've really flattened out since the Fed meeting and stabilized in this, 6.3 to 6.35 range. And, a little improvement last week, but it feels like we're holding steady on mortgage rates. What are you seeing, Cady?
Yeah, and I think we will hold steady on mortgage rates for a bit until I tend to say almost until we see the government reopen and we start getting data again. And when that data solidifies the fact that we will be in for another Fed rate cut, I mean, we saw the 10-year Treasury. What was it, about a 3-week window from when the Fed made an announcement they would likely cut to when the Fed cut actually happened. The 10-year Treasury was down exactly 25 basis points, 0.25%, which was what they cut. And so I do think with a rate cut being very probable at the end of this month, we may see a little more stagnation until the government opens up and we actually start to see data that solidifies that Fed rate cut. But I think the moment that Fed rate cut is solidified in traders' minds, and it's solidified that it's going to happen, we'll see interest rates begin their trek down ahead of that next rate cut.
Yeah, I'm usually slow to agree with anything that says, hey, rates are going to go down. But I've got to agree with you here. I feel like as soon as the government opens up, as soon as we get the data that has, been backlogged here a little bit, and it does show, we're going to get data after data after data that's going to support this Fed rate cut, which again, even beforehand, we're 86% likely, like we know this cut's coming. And what we saw before the last rate cut was really good rates up to an anticipation of the Fed meeting.
Right.
And it was great right as the Fed meeting was going on until Jerome Powell talked again and kind of negated the dot plot. But, JP do what JP does.
If I could add one thing to it, I think there is pause for a little bit of concern. I mean, we know how bad the BLS, or I like to call them the BS jobs report data is. We know how bad this is. And I do think that it would not be outside the realm of normal that when government reopens, we get the BLS jobs report that we missed. And the data is wildly inaccurate and it shows job strength. And that could completely turn everything on its head. And we know how much the Fed looks at the BLS numbers, not the ADP numbers. If for some reason it was a gangbusters report that will in the future be revised down 2 times, it could put a pause on an October rate cut. And that would really turn things on its head. So until we get that data, we don't know exactly what the Fed's going to do. And that's why I think we've seen the markets just flatline. They're as cautious about this as we are.
Yeah, I think there's, we're talking about low chance probability. Maybe I'm giving the BLS too much credit here, but trailing ADP like it does, I mean, you don't go negative 30,000 jobs on ADP and then somehow hit, jolts in new jobs added at, 193,000. Like that would be shocking. It's not out of the realm of possibility. It's happened before. I got to assume that we're going to pause and drop. And I think in the interim, during this hold pattern, like you said, we're going to be holding pretty steady. I think we're going to continue to see resistance on the Treasury bond yields. From that, if we get up to 418, 419, it's going to push back before it gets to 420. But we're not going to get any lower than I think 408, 409. The 411 to 415 yield is going to be just this sit and wait, see what happens. And so what that means to industry professionals, mortgage loan officers, realtors, buyers, et cetera, is, hey, if you've got something that works for you right now, cool, take action. If you're on the fence and you're waiting to see what happens when the government reopens because you think it's going to be a significant rate drop, I wouldn't. We're talking what's significant to Andrew and I is seeing the overnight average go from 635 to 615 to 619. Like that's significant to us. That's a pretty big move. That's not going to move the needle from it makes sense to buy now, but it didn't 2 weeks ago kind of thing.
Yeah. So, and I think you're super wise in what you're saying of if you're happy with what you got, lock it in now, because in the absence of news, in the absence of data from our government, our markets are very susceptible to international data. Like we saw the 10-year Treasury spike up this morning on data coming out of Japan. Whereas if we would have gotten our normal data sets, it probably would not have been as susceptible to the move we saw this morning. But when there's a lack of data, we're going to react to the smallest and things that aren't really consequential to us. So I think you're right. If you're happy with what you've got, probably a wise move to lock in what you've got today.
Yeah, Japan, EU push yields higher in both sessions. But again, you think about where the interest rates are in Japan and the EU, a lot lower than the US right now. They've already taken moves from their Fed. They're going to be, if we look at them for action, I mean, it's going to be a different type of volatile. And, I'm looking at a post right now. In practice, we're seeing one of the larger instances of overnight selling, ironically, extreme absence of domestic market movers can grease the skids for more volatility. Yep. That's exactly what we're seeing, but we're even seeing a bit of a rebound from that right now. I'm looking at mortgage-backed securities being fairly flat, down 3-4 basis points. If you're looking at the 5.0, it's down 9, but it's been a little bit bigger of a mover. When by the time rates open this morning, mostly flat, nothing to get crazy about. So
Right.
I don't know if we're going to see anything crazy going on. I don't track the Japanese and the EU markets the way I do the US because it's not as relevant. I hate that it is right now in the absence of US data. And I'm not about to go I nerd out on this pretty hard. I'm not going to go hard on EU and Japan stuff because I feel like our bond markets overreact and then recover pretty quickly thereafter. So looking forward, what to do this week, lock it if you like it. And that's going to be consistent for a long time. Look forward and expect that Fed rate cut, but also these are the conversations we should be having with our agents. If people are unsure what to do, unsure if they should wait, not sure how the government shutdown is impacting them on the mortgage rate side, well, now you know. It's a lot of stagnation, a lot of nothing going on. Anything you'd like to close us with, Andrew?
No, let's go out and have an absolute amazing week.
Crush the week, my friend. I appreciate your time. Thank you for joining us as a guest. It's always great to hang out and chat with you, my friend. And we'll see y'all back here next week.
Take care.